Hello, Edgar Denny here. Hope you all had a good weekend. I know it's been a tough year so far, and maybe the weekends are times to recharge and think about the meaning of life and all that. But the reality is, bull markets last a long time, and bear markets come and go. And right now, it certainly feels as though we're in a bear market. We came awfully close to an official bear market on Friday, as you know, on an intraday basis. We were down over 20%, and we had a interesting reversal day rally that brought the market back up above the minus 20% mark. But it still certainly feels like a bear market, and certainly is a bear market on NASDAQ. And in some of the biggest sectors of the S&P 500, we know the consumer discretionary is down over 30%. Information technology and communications services are down about 25%. So it's been painful for sure. Question is, where do we go from here? To the extent that we can declare that for all practical purposes, Friday marked a bear market. It's not as though the bear market just started on Friday. I think it's important to keep that in mind. It actually, with the benefit of hindsight, started January 3rd. That's when we made an all-time record high in the S&P 500. I think it's about 137 calendar days. So we're already well into this sell-off to the extent that it is a bear market. And that means that we now have to assess how much longer it's going to last and how much lower it's going to take us. All hard to say, obviously. I mean, clearly the Fed has only just started raising interest rates. Inflation still remains an issue. Credit spreads have recently started to widen, though not to levels that are of great concern, but they're going up. They're not going down, and that's something of concern. And then the latest data we have on May is the business surveys for Philly and New York, and those regional surveys combined, as I showed in one of my recent quick takes, suggest that the MPMI, the Manufacturing Purchasing Managers Index, which will be reported tomorrow, may not, sorry, let's do that again, be reported on June 1st, that number is likely to be down quite a bit, maybe down to 50, maybe slightly below 50. There is a pretty good correlation between the MPMI and these regional business surveys. Again, we have Philly and New York. This week, I think we get Kansas City and Richmond, and then early next week, we're going to get the Dallas Fed's survey. So manufacturing looks weaker here based on the Philly and New York surveys. Some of that may be supply chain issues. I think a lot of it is we've satisfied a tremendous amount of pent-up demand for goods. And despite that, retail sales, even on an inflation-adjusted basis, actually firmed up in April. So there's some signs that Americans haven't fully satisfied the pent-up demand for goods, or they still are capable of spending more in that area. But then again, the Walmart and Target disappointments suggest that a lot of consumers are being forced to spend more on groceries and gasoline, and they have less money to spend on other goods. And so when they walk into some of these big grocery and miscellaneous goods stores, Walmart and Target, not only can they get food, but they can buy clothing and some furniture, some lamps and things like that. So to the extent that they have to spend more on groceries and gasoline, they have less to spend on other items. And I think where Target and Walmart got tripped up is that led to more inventory of some of these discretionary consumer goods items that they have to discount. The good news in all that is consumer durable goods inflation and the consumption deflator and then the CPI is starting to show some signs of peaking. And this anecdotal evidence from Target and Walmart suggests that I don't know if consumers are resisting price increases on consumer discretionary items so much as that there isn't a lot left over once they've spent on groceries and on gasoline. That clearly, these kind of numbers clearly point in the direction of a weaker economy, a soft landing, and possibly a recession. And as you know, recession has become a very credible scenario. It's one that's been bandied about quite a bit. This will be probably the most widely anticipated recession of all times, if in fact it occurs. And if something breaks in the financial system that leads to the recession, it'll be the first time I can recall that the markets have been anticipating that something would break during a Fed tightening cycle. Certainly this early in a Fed tightening cycle would be quite amazing. The bears are out in full force. I will be going with my wife to Yellowstone Park, and we'll take our chances with some of the bears that are out there. We're going to go out there the day after Memorial Day. And I was just want to share with you a virtual background here. This, I guess, is what I'm concerned about, is that I'll be going to Yellowstone, and suddenly my virtual background will include a bear looking awfully mean and ready to bite. So we will be carrying some bear spray with us, and hopefully we won't have to use it. But could certainly use some bear spray for this market and for some of the more vocal bears that are out there. And I guess right now the most vocal is Jeremy Grantham. He's out there with a CNBC interview, almost overjoyed at how right he's been on the bursting of all these bubbles. And I mean, clearly the meme stocks, if somebody told me how to pronounce it, meme, not mem, the meme stocks bubble burst last year, and the SPACs bubble burst. We've seen bubbles bursting. The Cathie Wood stocks have bursted, but now we're seeing this market taken down good quality large cap names, bringing down their valuation multiples, while their analysts continue to expect pretty good earnings out of these companies. But Grantham seems to be of the opinion that this is going to be a protracted calamity for all of us, not just in the stock market, but in the economy. He points out that over the next 15 years, there's a labor shortage, and he expects that's going to keep wage inflation going higher and keep inflation higher. So it's a pretty depressing scenario that he paints. Let me counter that a little bit, but to do that, let's go and have a look at some charts here. So I'm going to share with you my charts. And you've already seen that one. So we'll zap it out. Okay, here we go. Chart collection for today. So yeah, I mean, it's been a nasty sell-off so far this year, though clearly the markets have still managed to maintain a huge amount of their gains since the beginning of the bull market. May not be over on it's over on the NASDAQ. It doesn't look like that much of a bear market, but 29% is officially certainly a bear market in the NASDAQ. Let's look at the S&P 500, and there it's a little over 18%, a little under 19% is the decline year to date. So we're getting pretty close to official correction. The equal weighted index is down something like 13%. So a lot of this has been the big cap names that got overvalued during the pandemic that are giving back some of their valuation air that was pumped in there. Now, I think that the bear story is pretty straightforward. They've been wrong for 13 years, and for 13 years they said, well, we wouldn't have been wrong if it wasn't for the Fed and the other central banks pumping in all this liquidity. And so now the comeuppance that they see for the bulls is that now we're going to pay a price because the central banks are being forced by inflation to cut back the size of their balance sheets, and that necessarily means that we're going to give back a lot, maybe almost everything that we've gained since the beginning of the bull market in 2009. Indeed, Grantham's saying that if we're unlucky, and he thinks we might be unlucky, it could be something like a 80% collapse in stock prices. So that would be a calamity for sure. But if you look at the correlation between Fed assets and the S&P 500, it's not overwhelming. I mean, it's kind of a trend. I mean, you can always put charts together of different things with upward trends, and you can say, see, one leads to the other. This is a little bit tighter correlation. This is the total assets of the Fed, the ECB, and the BOJ. And there you can see its correlation is a little tighter with the S&P 500 index. And we know that this blue line is rolling over already and will continue to decline as the Fed tapers the size of its balance sheet. So the bears certainly have that going in their favor right now. The Fed and the other central bankers are no longer expanding their balance sheets; they're contracting them. And then the relevance to the stock market is important. The blue line is the year-over-year percent change in the assets of the main central bankers, the Fed, the ECB, and the BOJ. And that I compare to, in the top chart here, figure 5, to the year-over-year percent change in revenues per share for the S&P 500, and down here to earnings per share. And yeah, I mean, during this bull market, there has been some correlation between the growth rate and the assets of the central banks, and it's almost been a bit of a leading indicator for the subsequent ups and downs in the growth rates of revenues and in earnings. And so this obviously doesn't look very happy for the stock market. And then we can do the same thing here using total assets of the Fed, ECB, and BOJ year-over-year percent change, and compare that to the S&P 500 index. And again, this time around, the correlation has actually been tighter on the downside. And again, the asset growth rate kind of led the yearly percent change in the S&P 500. But this is not necessarily lead to the conclusion that we're going to have these kind of bear markets that we had back in 2000 and 2008, 2009. And but then again, we don't have that going in our favor for those of us who like to believe that the world's not going to come to an end the way the bears are roaring these days. So figure 8 shows again the importance of the central bank asset growth rate, and it's has some correlation with the PMI, and so that's another indication that the PMI is going to be weak here. So we're on the weak side of the cycle for sure, and it's certainly weak enough to push us into a bear market territory here in the next several weeks, and possibly cause a recession. But again, I think the consumer is in pretty good shape with lots of personal saving that's been accumulated for the past few years. I think the business sector is in very good shape. The banks are in good shape. But then it's conceivable that consumers will just kind of fold here and decide that with lower income, lower wage workers facing higher grocery and gasoline prices, we all are obviously, but it hurts them more, and higher wage households seeing a chunk of their wealth kind of evaporate here with this sell-off in the stock market. And in the bond market, by the way, though the bond market's holding up, that may very well lead to some more weakness in the consumer that I'm anticipating. But we'll be monitoring it along with everybody else. This is just the growth rates and the balance sheets of each of the individual ones. This is, I guess, something to be quite concerned about, because the Fed not only is on course to raise interest rates, but also is on course to reduce its balance sheet, as you can see here. And this is the projection of what it's going to look like based on what they've projected. Well, so a lot of the bad news seems to be the perception that the Fed is the huge, the 800-pound gorilla in the financial markets, and that this bull market is all or mostly related to the Fed being the gorilla providing lots of liquidity, and now the gorilla kind of going the other way, morphing into a bear. Sorry about all these animal analogies. Maybe they don't work for you, but let's move on. So is there nothing to write home about, to be excited about? I don't think that the outlook is as grim and pessimistic as the bears seem to be suggesting. This too shall pass. I think we are going to see inflation peak. I think it's peaking in terms of consumer durable goods inflation. I'm seeing some signs of a peak in even commodity prices, industrial commodity prices. Meanwhile, this notion that this is going to wind up to be tech wreck 2.0, comparable to the tech wreck that we had in the early 2000s. Just this doesn't jive as far as I'm concerned. Just doesn't make sense to me. We have here, for example, industrial production of high-tech equipment. And back here, we had a big drop-off in communications equipment. There was a lot of seller financing of telecom equipment. That was a big component of the tech wreck. It wasn't just a lot of spending on Y2K that suddenly stopped. There was also a lot of spending on telecom equipment that suddenly stopped. Then we had another bull market in the fundamentals of technology. If you look at the red line, it's probably more accurate in terms of looking at the overall sector. And it looks awfully strong. Doesn't mean that it can't kind of roll over and create a real fundamental problem for earnings and make this a calamity like tech wreck 2.0. But I just think companies are spending a tremendous amount on technology now to offset labor shortages to increase productivity. And that's the one word that I did not see that Jeremy Grantham or any of the other bears are mentioning is productivity. The response, I think, of businesses to inflation isn't to come into work every day and figure out how can I be the best at passing through my costs into prices. I mean, that's what they're doing. But most companies are thinking, how can I deal with this environment by lowering my costs in a phase where there are so many costs going up? How do I deal with the labor shortages? Just raising wages isn't going to attract more workers, and it isn't necessarily going to keep workers. There is a fundamental shortage of workers. And I think you're going to continue to see a technology spending boom to offset that. And that's where productivity really comes in to save the day. And this is not down the road. I think it's already happening. I think it's been happening for the past few years. Productivity was growing at only 0.5% back in 2015. Now it's 1.5% in the first quarter. It was better than that. It was 2%. And I'm using a 20-quarter average to kind of get at the growth rate of the thing, as you know. But that's kind of the heart of my story. So right now, it definitely feels like the great inflation of the 1970s all over again, the great inflation 2.0. But I think underneath it all, we're going to see that the roaring 2020s prevails increasingly as the decade progresses. And I'm not talking about the end of the decade. I'm talking about over the next few years, we're going to see more and more signs of that. Meanwhile, again, we kind of take a look at forward earnings for the various tech sectors in figures 13, 14. You can have a look at them in your spare time. Try to get it on a ratio scale, but you can't do a ratio scale when there's negative values. But it's pretty clear that the percentage percentage change drop-offs in forward earnings in technology during the tech wreck 1.0 was huge. And this time we haven't even started to see something like that. And I don't think we're going to see anything close to that. So that's what we'll be watching on a weekly basis. Meanwhile, I mentioned CRB Raw Industrial Spot Price Index, got magnifying glass, can see some peaking there, led by metals prices, as you can see here. So that could be a sign that a recession is about to occur in the US. More likely, it's a sign that the global economy is slowing down, and that if there's a recession anywhere, it's probably in China and probably in Europe. And again, I'm not in the recession camp for the US. I'm talking about a 30% chance of recession in the US this year and next year. And if it's going to happen, it's more likely to happen next year than this year. But as you know, the consensus increasingly is that a recession is imminent. It's going to happen sometime this year and soon. So here's that story on productivity I was telling you about. I've shown you that before. You can look at it on your own. And I've shown you this chart on figure 18, showing you the growth rate of labor force. So Jeremy Grantham and I agree on one thing, and that is that there is labor shortages. And certainly we're not growing labor force by 3% the way we were back in the 70s. And by the way, productivity collapsed, as you can see in this top chart. And in Grantham's scenario, the labor shortages persist and lead to higher wages, wage price spiral for as far as the eye can see. In my story, the labor shortages lead to a continued acceleration in productivity growth to 4% within the next few years. and productivity is the magic variable that makes the good times come back and puts the bears back into their caves. But right now, the bears are having loads of fun. So that's it. Let me turn to the questions here. Will quantitative tightening make mortgage-backed securities cheaper compared to treasuries? Good question. Yeah, I would think they could. I mean, the Fed clearly wants to get out of the mortgage business. They had no business being in the mortgage business. For a while there, I was calling them Freddie. You know, we had Freddie Mac and we had Fannie Mae, and I was calling them Fetty because they were buying a lot of mortgages. And to the extent that they have been sold, I mean, the mortgage yields have gone up very, very sharply here, along with treasuries. But we are seeing a bid in the treasuries more so than in the mortgage market. So I think that's a reasonable supposition. Doug, have there been bear markets in the past where entire segments of the market have trended higher, like energy, metals, and utilities today? And while we're at it, how can utilities be railing when interest rates are rising? Does that indicate a flaw in the Fed tightening, higher rates? Good question, Doug. I'll look at it more closely. I don't know the answer right offhand. I guess I don't recall too many sectors or stocks going up during the previous bear market. And of course, the bear market in 2000 was mostly a tech wreck, but that was because other stocks didn't participate in the bull market that occurred in the late 1990s. But we'll have a look at that. We're doing a little anatomy of bear market anatomy, if you will, for tomorrow. Okay, asset preservation advisors, thoughts on the 10-year Treasury year-end 10-year rate. 3% seems to me to be a rate where investors have come in. It's consistent with the ratio of the copper gold ratio. I think in this world of geopolitical uncertainty and lots of other uncertainties, looks like the 2-year and the 10-year have finally started to stabilize here. They led the way to the upside, so maybe they're already signaling to us that it's we're not likely to see rates go much higher from here, which may be a call that a recession is imminent and that'll bring inflation down, or a soft landing will bring inflation down. But it's certainly not a call that the Fed is so far behind the inflation curve that interest rates are going to have to go a lot higher. As you know, Fed officials have been arguing that they aren't that far behind the inflation curve, that they have used forward guidance to talk the credit markets into tightening, and that's definitely been the case over the past year. Credit conditions have gotten a lot tighter. Okay, David, given it is not the 1970s, does that alter your bullish view on energy? Good question. It is the 1970s right now. It certainly feels like it. We even have Jimmy Carter back again in Joe Biden. I mean, talk about bad policymaking and the kind of an inability to deal with a crisis and reality. So that is of concern. But I guess my optimism is based on my view that companies have never been better managed, that they are going to hold on to their profit margins, they are going to spend on the capital equipment, they are going to increase their productivity. So that's the roaring 2020s scenario that I think will come out of this 1970 scenario. And I don't think this is going to last very long. I think we've all observed that change occurs very, very rapidly these days. We had a horrible recession in 2020 that lasted all of 2 months. We had an amazing recovery that took only 12 months to bring real GDP back to where it had been before the pandemic. Then we seem to have something that felt like a inflationary boom, and now we got something that feels like a stagflation. So I guess in line with that kind of argument, it would be plausible to have a recession, one that's pretty quick. It would be plausible to have a bear market, one that's pretty quick, and maybe that's the way things are unfolding currently. But the story for energy really has a lot more to do with climate change activism. The climate change activists have been very successful in forcing fossil fuel companies to cut back, looking for more fossil fuels and producing it and distributing it and so on. And so a bully for them. The only problem is they never mapped out a plausible, civilized, workable transition from fossil fuels to their clean energies. And as a result, a lot of the fossil fuel management seem to have basically come to the conclusion that, well, if that's the way they want to play the game, if they want to, force us to cut back our spending, we'll do it. And that means our expenses go down. And meanwhile, watch what happens to energy prices. They'll go up. And Elizabeth Warren can squawk all she wants, but the fossil fuel companies are just going to be rolling in dough, making money in cash flow and in profits, which is exactly what's happening now, buying back their shares or paying out more dividends. So that's really the heart of the energy story, much more so than this is a repeat of the 1970s situation. Okay, so another question from David, precious metals. Hard for me to get excited about gold. Gold is inversely related to the TIPS yield. Maybe that has something to do with the real cost of storing gold. Whatever it is, it's worked pretty well. And right now the TIPS yield has been very strong to the upside, which suggests that gold should be down, which gold certainly hasn't been going up with inflation and the geopolitical uncertainties. And even to the extent that Bitcoin was viewed as the new digital gold by some as an inflation hedge, to the extent that the cryptocurrency market's showing definite signs of losing a lot of air. That doesn't seem to have helped gold either. Kind of like gold and silver as the shiny metals, but I'm not, they just haven't worked. And I'm not sure they're going to suddenly work. Andrew, how do you think about the decline in productivity in Q1? Is that a measurement problem? Andrew, thanks for asking. And the answer is any data that doesn't support my story isn't good data and is bound to be revised or wait until you see what happens next. The first quarter was kind of funky. Real GDP was down, even though final demand was very strong. We had this huge increase to a record high in the current account deficit, the trade deficit, and that's not likely to persist. Meanwhile, I think we are going to continue to see 2-3% growth rates in final demand. Consumers and businesses continue to spend. I don't think that's going to have negative signs to it. A lot of people are thinking that so these days. In that chart, I included the first quarter. It is what it is. It is a 20-quarter average, though, so it smooths everything out. And yet that was such a big decline that it did lower the 20-quarter average annual productivity growth rate from 2% in the first quarter, which I liked, in the fourth quarter, which I liked a lot, to 1.5%, which I liked less in the first quarter. So it didn't change my mind about the underlying story for productivity. Let me put it that way. Al asked me about gold, which I responded to. Gold in a relationship to currency debasement. Again, you would think that with inflation going up, with the currency debasement that has occurred, if you look at central bank balance sheets, that gold should have done a lot better. But the one relationship that seems to have held up the best is that inverse relationship between gold and the TIPS yield. I'm just being factual about it. That's what the chart shows. And of all the relationships that are out there that you could kind of use to try to think about gold, that relationship suggests hasn't been bullish for gold. Gold, by the way, also has tended to be a good indicator of the underlying trend for commodity prices. And here we've seen commodity prices going straight up, and yet gold hasn't participated. So something's got to give, in my opinion, here. Either gold is right or the other commodity prices are right. Jeremy Grantham is saying you ain't seen nothing yet when it comes to the commodity boom, and gold is disagreeing with that, and I disagree with that. I think weaker economic growth in China and in Europe are leading to slower global economic growth, and I think we should be seeing that in weaker commodity prices. And maybe that's what gold has been telling us, that the underlying trend in commodity prices isn't as rip-roaring to the upside or sustainably to the upside as suggested by commodity prices. Let's see, we got one more here. Brian, interest rate increases may influence demand, but doesn't affect supply issues, correct? Will supply ultimately catch up? Some argue that to sufficiently lower demand to more closely match supplies, we need to enter a recession. What's the counter to that argument? Yeah, all good questions. I think, there is a big debate here or interaction between supply and demand that's had a tremendous impact, certainly on inflation. And it's my view that we had a demand shock with the helicopter money drops of millions of dollars, billions of dollars into checking deposits, 3 rounds of checking deposit helicopter drops in response to the pandemic. The third one certainly seemed to be the one that was most inflationary, but it wasn't just the helicopter drops this modern monetary theory at work. It's not just the Fed, it's also the fiscal authorities. We've really never had helicopter money the way we have had over the past couple of years, where the fiscal authorities were dropping money into people's accounts, and the Fed basically accommodated that with ultra easy monetary policy. So now what? Well, the demand shock created a supply shock. I mean, we did have record imports into the U.S. in recent years, in recent months, I should say, and that certainly belies the notion that the supply system is broken. I mean, we are getting stuff into the country through our ports for sure. And we have recently seen auto production picking up, suggesting that some of the semiconductor issues seem to be getting resolved one way or the other. But on the demand side, I think a lot of pent-up demand has been satisfied, and I would expect to see some weakness there. And that's where I expect to see some disinflation, lower inflation in consumer durable goods prices. On the other hand, services, particularly rent, we have a shortage of housing, and rent inflation is going to continue to be an issue. But the bottom line is, the easy way to solve the inflation problem is to just have a recession, and maybe that's what the markets are most concerned about. Is that's the only way to bring inflation down. So the inflation numbers are going to be vitally important. Unfortunately, the next important one, well, actually, we're going to have a couple of regional business surveys, which will give us some indications of prices paid and prices received. But on Friday, we're going to have the personal consumption expenditures deflator for April. We already have the CPI, and we know that there's some signs of peaking in consumer durable goods inflation. But rent inflation is an issue. But rent inflation has a smaller weight in the PCED. The bottom line is, on Friday, we're not going to get a lot of relief on the concerns about inflation. It's going to be sort of a mixed bag number. And Fridays these days are not happy days because people don't want to be positioned going into the weekend. So maybe we got that, particularly with the Memorial Day weekend up ahead here. But look, I'll do my best to, if I confront any bears when my wife and I go to Yellowstone and Grand Tetons next Tuesday, we'll have bear spray with us. And I'll continue to do the best I can to objectively analyze the economy and financial markets and avoid getting mauled, at least psychologically, by the bears. They are certainly having a tremendous impact on pessimism. Never seen so much pessimism, never seen a recession so widely anticipated, never seen so many people anticipating that something will break in the system. And maybe all that is where we're heading fast here. But again, we'll do our best to be objective about the data as it comes in, and maintain our optimism about the future. I don't think that the bears are going to be right about their long-term pessimism. Well, thanks very much. Thanks for joining us. Have a great week. And I guess next week I'll pre-record. Thank you.